Those of you waiting for twos and threes, here's an example. You can at least break through four and get to the high threes with this strategy. And by the way, I say permanent rate buy down because with the FHA ARM, you cannot do a temporary 2-1 or 3-2-1. That's not allowed. So you would do that $15,000 credit would pay for the points to get the rate down to 3 7/8. What does that do with your minimum down payment on that price as to the monthly payment? Well, get this, principal and interest, $2,212. I don't know about you, 3-bedroom, 2-bath home on a standard sized lot. I think this property was around 1,600 square feet. $2,212. Now, granted, that doesn't include your property taxes, doesn't include your homeowner's insurance, but still, $2,212. I would argue that's very competitive to what rents are. I mean, how many stories have you heard about somebody renting a modest 2-bedroom apartment that's costing them $2,500 a month? Well, there you have it. Now, of course, yes, you add taxes and insurance, you're going to get up closer to $3,000. But again, you're buying nearly a $500,000 home with a minimal $16,765 down payment, and you're getting 3 7/8%. Now, what does this ARM do? How is it structured? Well, you're going to have that initial rate, and therefore the corresponding $2,212 payment. That's fixed for 5 years. No changes. It's fixed for 5 years. Then what happens is the loan adjusts annually every 12 months after that. So then you say, okay, so what are the caps? Well, in the first adjustment in year 6, 1%. So now I didn't mention, ARM loans are going to have an index with a margin added to it. With the FHA loan, it's a 1-year CMT, constant maturity treasury index. Right now it's around 3.6. And then a margin is added to that, 2.25. So you add those together and voila, you're talking about high fives. So let's assume after 5 years, the loan's adjusting and the index plus margin calls for a 5 7/8 rate. Well, you have a 1% cap. So despite that index plus margin in year 6, you're going to only go up by 1% to 4 7/8. You're not going to go to that 5 7/8 because you have the 1% cap. That cap stays in place annually every year for the remaining 25 years. So it's 1% at the first adjustment, 1% each subsequent adjustment. Over the life of the loan, 5% life cap. So on a 3 7/8 bought down rate, when you got that seller credit, you're going to have a life cap of 8 7/8, single digit life cap. That gives you lots of protection in a rising interest rate environment, which of course it would have to be a sustained rising interest rate environment to ever get to that life cap.